Welcome to Housing Market Savvy. I'm Pat Kapowicz with your weekly California housing market briefing, straight from the Association of Realtors, aka CAR, the most trusted source of real estate data in the state. I'm bringing you the CAR California latest market and economic data report from our economists and their excellent economic team, the numbers, the economic context, and what it all means if you own a home or are thinking about buying or selling one in Silicon Valley or anywhere in California. This report is for the week ending February 14, 2026. The economic write-up is dated February 16, 2026. First, the weekly snapshot. These are daily averages for the week ending February 14, 2026, based on statistics collected from the multiple listing services across the entire state of California. 198 closed sales per day, 238 pending sales per day, 327 new listings per day. Now, what does that mean? More listings are coming on the market than home sale transactions are closing. 327 new listings per day against 198 home sale closings. That gap matters for home sellers timing their entry. Supply is building. Now, here is how realtors performed the previous week. 24.2% of realtors closed a home sale, up 0.4% from the prior quarter. 16.9% entered a home sale into escrow, down 6.4% from the prior quarter. 25.8% listed a property, down 1.4% from the prior quarter. And looking ahead, here is what realtors themselves expect to happen in the coming week. 12.4% believe sales will be up. That's down 2% from the prior quarter. 5.9% believe prices will be up. That is down 1.6% from the last quarter. 28.8% believe listings will be up. That is down 16% from the last quarter. Agents are more cautious heading into the week. That 16-point drop in listing expectations is significant. It tells me agents sense that the burst of new inventory may be slowing. Watch that number in coming weeks. Now for the California Association of Realtors economic analysis dated February 16, 2020. I am reading this directly from the CAR report. Macroeconomic indicators suggest that the economy is stabilizing, a condition that would allow the Federal Reserve to put things on hold for now, but may still cut rates later this year if it is necessary. With January job growth exceeding nation's inflation surprising on the upside at the start of 2026, the economy is holding up better than previously thought. The Fed will likely remain patient and may not reduce its policy rate in the coming Federal Open Market Committee meetings in March and April. Flat retail sales and a reverse in small business optimism, however, provide a cautionary note that shows the economy is not out of the woods. A rate cut could still take place in the second half of 2026 if signs of distress are detected. The market has reacted positively after digesting the latest news, with the average 30-year fixed mortgage rate declining to its 3-year low last Friday. This is good news for the housing market, as a dip in rates will further the improvement in affordability that we have seen in the last couple of quarters. California housing affordability improved from the third quarter 2025 and a year ago. Housing affordability in California improved from both the previous quarter and the same quarter last year. The statewide housing affordability index for existing single-family homes inched up 1 percentage point from Q3 2025 to 18% in Q4 2025, and rose 2 percentage points from its year-ago level. While the statewide median home price moderated in Q4 as market competition cooled and seasonal factors kicked in, borrowing costs remain elevated by historical standards but continued to ease and reach the lowest level in nearly 2 years. The monthly mortgage payment for a medium-priced home, including taxes and insurance, slipped 4.7% from the prior quarter and dipped 4% from a year earlier as the effective mortgage rate declined in both quarter-to-quarter and year-over-year basis. Inflation slows at the start of 2026. The latest consumer price index came in lower than expected, with core CPI reaching the lowest in nearly 6 years. The January headline CPI increased 0.2% from the prior month and climbed 2.4% from the same month last year. With both growth rates pacing lower than economists' expectations, core CPI dropped to 2.5% year over year and recorded the best reading since March 2021. The slowdown in inflation was due partly to a drop in gasoline prices and a decline in used car prices. Shelter cost, a category that accounts for more than 1/3 of the CPI weighting, it was still up 3% on an annual basis, but improved from the 3.2% gain recorded in December 2025. Grocery prices moderated on a year-over-year basis in January, but restaurant meal price growth remained high last month. Despite seeing an encouraging start to the year, prices on computers, appliances, and hospital care remain elevated and continue to weigh on Americans. The Fed will likely keep the Fed rates unchanged in March and April, but may make a move or two before the end of the year. Solid jobs growth in January likely put the Fed on hold. The U.S. labor market kicked off 2026 with a strong note, with non-farm payrolls rising a seasonally adjusted 130,000 in January, the largest increase observed in the past 13 months. The unemployment rate also fell to 4.3%, the lowest level since August 2025. Most of the jobs gained last month were in healthcare, 82,000, social assistance, 42,000, and construction, 33,000, with hiring concentrated in a handful of industries, and the latest downward revisions showed the economy added a much smaller number of jobs in 2025. The health of the labor market remains a concern, with hiring concentrated in a handful of industries and the latest downward revisions showing the economy added a much smaller number of jobs in 2025. The health of the labor market remains a concern. Nevertheless, the rebound in job growth is still encouraging and offers hope that general employment conditions are stabilizing. Meanwhile, the average hourly earning increased 3.7% from the same month last year, and average weekly earnings jumped 4.3% on an annual basis, which is an indicator that suggests steady wage growth is keeping up with the increase in consumer prices at the aggregated level. With the latest report showing signs of stabilization in the labor market, the Fed has more reasons to push for no changes in the rate in the upcoming meeting in March. Small business optimism moderates but still remains above its 52-year average. The Small Business Optimism Index of the National Federation of Independent Business dipped in January after climbing 2 consecutive months, but continued to stay above its 52-year average of 98. More respondents reported that the overall business health improved in January, with the net percent of owners expecting higher real sales volume in the next quarter jumped 6% from December. The Uncertainty Index, on the other hand, completely erased the improvement made in December and rose 7 points last. Those who raised their average selling prices in January were down 4% from the prior month, but the net percentage of owners who plan to increase prices in the next 3 months climbed 4 points from December, which could be an indication that upward inflationary pressure could linger on in the months ahead. The cost or availability of insurance has become the biggest issue for small business owners. The share who reported it as their single most important problem increased by 4 points in January and reached the highest level since December 28, flatline to end 2025. Sales at U.S. retailers and restaurants were flat in December compared to the prior month, as rough weather and pull-forward sales negatively affected retail spending. The headline retail sales figure recorded a 0% change month over month in December and registered a year-over-year gain of 2.4% from 12 months ago. The annual growth rate for the non-inflation adjusted retail sales figure was the smallest since September 2024 and is much smaller when inflation is accounted for. Sales declined for vehicles, furniture, and electronics were offset by growth in building materials, dining out, and gasoline. With retailers advertising aggressively and offering discounts in October and November, sales might have been pulled forward prior to the last month of the year. Unfavorable weather conditions likely played a role, as well as the dip in consumer demand in December. That is the full California Association of Realtors market update for the week of February 14, 2026. Let's review a few takeaways. 1. Mortgage rates just hit a 3-year low. If you have been sitting on the fence waiting for rates to drop, the market is giving you a signal right now. 2. California housing affordability is at its best level in 2 years. Still, only 18% of households can afford a median-price home, but that number is moving in the right direction. 3. New listings are outpacing closings. 327 new properties per day versus 198 closed home sales. If you are a home seller, your window to get ahead of growing competition is now, not after spring inventories peak. Now, if you are thinking of selling your Silicon Valley home, whether it's a standard sale, a trust sale, or probate sale, I want to talk to you. I'm Realtor Pat Kapowicz, a certified real estate brokerage manager and certified trust and probate specialist. I've been protecting home sellers for decades through every imaginable market. You can find me at siliconvalleybroker.com and more details in the show notes. And if you are a Mercury News reader, that is a newspaper of Silicon Valley, my consumer protection column has been running in the Bay Area news group since the 1990s. You will find a link to my archive in the description of this episode. I will be back next week with more real estate updates from trusted sources. Until then, know your market, protect your equity, and make informed decisions. I am Pat Kapowicz. Thanks for listening.